Hey, good morning, everyone. Chilly day in Houston, Texas, and the Price Group welcomes you to our topic today, retirement planning timeline. Look before you leap, so very important. We're going to be talking about this subject in about 30 to 40 minutes. Time for you to type in questions at the end, and our goal is to get information to you in a relevant manner to help you make decisions as you near retirement. Who are we? We are the Price Group, family owned and operated group. We follow a fiduciary standard, and retirement is the thing that we do. We're passionate about the fact that everyone needs a wealth coach. 90% plus percent of our clients are retired. Randy Price and Matt Price here this morning with you. About our firm, we are an employee-owned firm. As I said, operate as a fiduciary. Stewart Partners has about 17 billion or so in assets. We're not owned by a bank or brokerage firm. Our custodian and back office is the investment firm of Raymond James, member of the S&P 500, a very fiscally conservative firm located in sunny Florida. Should you listen to the Price Group, accolades, education, etc., we are honored and humbled to serve clients here in the Houston area and actually all across the country. We do these wealth podcasts on a regular basis for information, and again, appreciate your time this morning in joining us and looking before you leap. Today's agenda, we're going to talk about retirement planning 2 to 5 years out, retirement planning less than 1 year out, and planning after retirement. So the key here is the word plan. So let's look at number one, retirement planning 2 to 5 years out to get us started here. So what do you do when you're 2 to 5 years out? You're still thinking, you're still looking. The problem with determining when you're 2 to 5 years out in Houston is that sometimes things change due to COVID, due to oil prices, etc. And so it's always good to know where you are. We talked about look before you leap. We are of the impression that everyone needs to create a wealth and investment plan. It's not written down. It's not a plan. We're going to talk about what is a family index number. It's the rate of return you need to be successful during retirement. Key foundational attribute of what we do for our clients. You want to evaluate, again, at this junction, your retirement plan contributions, your allocations. As you get closer to retirement, your allocations should be equal to what you want in retirement as a whole. Many times people are 100% allocated to a company stock, and they've just sort of gotten there by, wow, it's been doing well, or I just haven't made a conscious decision to diversify. Key consideration here is what could a negative year in the stock market, back in March, we saw that quite vividly, but what could that do to your retirement date and your standard of living? It's more fun to work when you work because you want to than when you work because you have to. And so we think that's a key consideration. That family index number again comes into play. And number five, we think you need to consult or hire a qualified advisor who specializes in retirement planning. Sometimes difficult to do from a standpoint of, who is a specialist, who is a salesperson, and who is a fiduciary. But qualified, we can get into more, but someone who has their certified financial planner, someone who has experience, someone who works with a team. As we move forward, this is a very important, I think, slide to be aware of. A lot of us are very proficient, perhaps, at making Excel spreadsheets, and we've seen folks come into our office with very long, very detailed spreadsheets, and they say, I think I'm pretty well prepared for retirement. But a spreadsheet has got a very potential big problem, and let me point that out and show you here. let's say that, and it has to do with the sequence of return in retirement. Let's use an example of beginning assets of 100,000. There on the upper left-hand side box, you see that we have a 10-year period, and you've got a rate of return of negative 15% in year 1, 7% years 2 through 9, and in year 10, you have a good year. Congratulations, you make 29%. Your money has grown to $188,000. That's an average return of 7%. Congratulations. Drop to the box below that. You flip the good and the bad year. You get the 29% positive return in green in year 1, and then you get the negative year there in year red, down 15% in year 10. And voila, look what happens. Sequence has no effect on your returns while you are in the accumulation phase. Prior to retirement, by definition, you're in the accumulation phase. Now, let's go to the upper right-hand box, and let's make the circumstances a little bit different. You've retired, and you are taking a withdrawal from your portfolio. The punchline here is the sequence of returns has a dramatic effect on your returns in the distribution phase. You're retired, you're living on your income, then you are in the distribution phase. So again, same set of numbers, start with a negative return in year 1 of minus 15%, 7%, 7% on down, 29% in year 10. Sad news, you've run out of money by year 10, and you are effectively no longer able to retire without going back to work full time. Now, let's flip it and put the good year, the green 29% in year 1, and the negative 15% in year 10. And what happens? It has a dramatic effect on the amount of money that you have left. So as you get to retirement, as you get toward the distribution phase, it's very, very important to realize that the sequence of returns can have a dramatic effect on your retirement. And thus, we focus on making income in retirement as opposed to total return in retirement. Sounds like perhaps a small difference, but it's a dramatic difference in the way the portfolio is invested, and it can have a dramatic importance in making sure that you do not ever run out of money. You need more than just an investment guy. Everybody needs a wealth coach. Benjamin Graham, Warren Buffett's mentor, said the best way to measure your success is not by whether you're beating the market, by whether you put into place a financial plan, and the key, a behavioral discipline that likely gets you to where you want to go. So we talk about holistic financial planning. We talk about investments. Those are fun. Those are sexy. Those are exciting sometimes. But income tax planning, estate planning, cash flow, insurance, goals and objectives, charitable planning, how to pass assets on, how to protect assets. Obviously, insurance could cover long-term care, Medicare, and Social Security planning as well. So anyway, we think a wealth coach is warranted at this critical stage of your lifetime. What should a retirement plan include? Retirement's not an event, it's an ongoing process. As I said earlier, if your plan is not written down, it's not a meaningful plan. We like to use the analogy of a roadmap. How much can I spend in retirement? How long will my money last? What rate of return do I need in retirement? And of course, how do I invest my portfolio in retirement for increasing income, not just income, inflation, and also protection of principal? If you've looked at mortgage rates lately, interest rates have been moving higher. We call here at the Price Group our retirement plan a Live Well plan. Our goal for all of our clients is to live well. The goal, comfort, clarity, and confidence as you put into place a plan that meets your needs, is easy to follow, and is, again, a process that we can follow year to year to make sure you're staying on track.
And a big part of that Live Well plan, like Randy mentioned, is our family index number. We boiled this down to try to make it easier for retired clients to track their progress. And so we publish monthly statements, as you would imagine, but in addition to that, what we provide clients is actually a performance data chart, and we're tracking their performance of the portfolio against this family index number. And so think of it this way. We're looking for the average rate of return over a market cycle, call it over a 10 to a 15-year period. And some years will outperform that, some years will underperform that. Our goal is to average that rate of return over a long period of time. It doesn't really necessarily represent a ceiling. For example, this past year, most portfolios, even with COVID, had exceeded their family index number just based off the fact that stocks and bonds both were positive. So it's a great way to track the progress of your plan. And like Randy mentioned, in retirement, investing is not necessarily about beating some arbitrary index. It becomes more and more focused on income and more specific to your family and what your goals might be in retirement. Another big thing we'll talk about 2 to 5 years before retirement with folks is how do we save in retirement plans until we do get to that magical retirement date. And quite a few different numbers here on the screen. You'll see from 2020 to 2021, there hasn't been an increase in what you can put into your 401k. That brings up a good point, though. On a Roth contribution to any retirement plan versus a pre-tax contribution, there's not necessarily a right or wrong answer. It depends on a number of factors, but obviously the Roth contribution, you do not receive an itemized deduction, but that will grow income tax-free, and the distributions will also be taken out tax-free. So it becomes a little bit of a cat and mouse game when we're plugging in the numbers and studying this for folks from a standpoint, what do we think our tax rate is going to be in retirement? It does look like the Biden administration is looking to potentially increase ordinary income tax rates for some of the higher earners. It's possible to be this year, probably next year is what it's looking like, but wait to be determined on that. So a few different ways that a few ideas for you to consider as you do approach retirement. Number one, we call it the Backdoor Roth. Some of you probably are familiar to this, but here's how it works. You make a non-deductible contribution to an IRA, non-deductible meaning you don't get an itemized deduction on it on your income tax return. And then 1, 2, 3 days later, you convert that from an IRA to a Roth IRA. Now, you would owe ordinary income on any gain within that time period. However, with that being said, you put in $6,000, you convert it the next day, there's obviously no gain on that. The real place you can stub your toe with this is what you can see on the screen, step 3, the pro rata rule. And what that means is if you have another IRA, you have to take into account those pre-tax dollars. So this strategy really doesn't work well if you have another IRA. However, the pro rata rule does not apply for a 401k company plan. So a few kind of pitfalls to avoid there, but this is a great way before retirement to get some money into a Roth IRA prior to retirement. Idea number 2 here, it's pretty similar, but a little bit different. Idea number 1 was with IRAs, like we said. Idea number 2 here with 401ks. What a lot of company plans will do, they'll have 3 different bucket options when adding money to the company plan. You'll have your pre-tax bucket, you'll have your Roth bucket, and you'll have your after-tax bucket. And what you can do is if you are already maxing out the Roth 401k bucket or even the pre-tax 401k bucket, you can also add money to the after-tax portion. And at retirement or separation of service, what you can do is you can actually roll that after-tax portion into a Roth IRA. So some people like to refer to this as the mega backdoor Roth option. You can put in more into the after-tax portion than the actual Roth IRA. But shoot us an email if you have any specific questions on this. A great planning tool that we do recommend for clients as they do approach retirement from a savings standpoint. Another thing we want to mention, evaluating your risk budget. Here's a really interesting chart. I told my wife over dinner, I said, babe, talking about downside portfolio protection is interesting. She corrected me and said, sweetheart, neither I nor the general public really do find this interesting. It might be helpful, but not interesting. So I guess I should correct myself. Maybe this is a helpful chart opposed to an interesting chart. The purple line there is the S&P 500 from 2000 to 2015. So you own 100% stocks, you're down, you're up, you're down, you're up. Congratulations, you're up 204%. Now, the green line is what if you only took 50% of the upside capture, but also 50% of the downside capture. So if stocks are up 10%, you're only up 5. If stocks are down 20, you're only down 10. And what you see here is you actually outperform in this 15-year period based on how the market performed by just taking half of the upside and also half of the downside. This is something we would encourage you to consider as you do get closer to retirement. The old adage, we don't know what we don't know. We don't know if there's going to be another 32% pullback like we saw last spring. We don't think so, but we didn't think we were going to have a 30+% pullback this time last year. So with that being said, as you do get closer to retirement, we want to consider mitigating some of the risk in the portfolio and get you closer aligned to your risk budget that you would have in retirement. Now, one of the main questions we do get is, hey, my savings plan, my 401k, where I'm close to 100% stock, but I also have a pension lump sum that is close to or equal to my savings plan, my 401k. How do you view that? We view that as a big old CD sitting there over on the side. So just hypothetically speaking, you have $2 million in your 401k, you got another $2 million in a pension lump sum. We would consider that a 50% weighting in stock. And so obviously that's a big line item on your balance sheet, something that needs to be taken into account. But without that pension lump sum, there are situations where we will consider reducing your risk exposure just to prevent having to work an extra year and push back that retirement date.
So our thought is, again, everybody needs a well coach. Tiger Woods has a swing coach, and we think that no matter where you are, retirement is an especially daunting and complex set of calculations, and that coaching can be very helpful. A couple of bullet points here. Emotions matter when you're investing. As Matt talked about this past March, very difficult period, 2008. 1999, 2002, anytime that the markets get crazy, don't make sense. You get closer to retirement, the mistakes are more costly. Getting into stocks at the wrong time, getting out of stocks at the wrong time, not understanding your fixed income portfolio, this sort of thing. Advantage of an advisor, stress reduction, additional investment options available, whether it be alternative investments, strategies for additional income, the use of individual bonds to defray the effects of higher interest rates. And then interesting, the Vanguard study several years ago showed the average investor, because of rather than buying low and selling high, did exactly the opposite, has underperformed. And in fact, another good example of this, many of you may remember Peter Lynch, who ran the Fidelity Magellan Fund, which at one point was the largest mutual fund in the world. A reporter asked him one time, they said, Mr. Lynch, what was your greatest investment regret? And the reporter later said that he expected an answer like, I didn't buy a certain stock when it went on sale or when it first came out or whatever. He said, oh, that's an easy one. He said the average investor didn't come anywhere close to that average return of my fund. And he went on to point out that all mutual fund companies do this, but they can go back and anonymously say, well, we had 10,000 investors and they put money in at this time, and they took money out at this time, and what was their average return during their time period in the particular mutual fund, in his case, the Fidelity Magellan Fund. And what he found, and what Fidelity had told him, was that people, when things were going well, said, hey, I'll put some money in stocks, look like they're doing well. And that was not as good a time to put money in, obviously, as stocks were, quote, not doing well. And therefore, the average investor didn't make the average return of the fund. So take your emotions out of it. Sounds very simple, but we think that's a powerful way to increase the confidence level. And that's really what we're all about here with our Live Well plan, looking at the confidence level that you can enter retirement. Because if you have a high degree of confidence, because if you do have information, then that leads to, if you have that clarity leads to comfort. Comfort leads to confidence, and those are important things with regards to retirement and retirement planning. Retirement becomes a lot more fun as opposed to worry about where my next monthly check is coming from. So let's pivot from 2 to 5 years out to less than 1 year out. You're getting excited. You've possibly got some trips planned. What are you doing? But let's look at a better estimate of your income during retirement. What does retirement look like? I remember somebody saying, well, when I was working, I only spent money on Saturdays. And this gentleman said, well, during retirement, every day is a Saturday. So what are your income needs? You're going to be making gifts? Are you going to fix the house up? Are you taking some big trips? You have a remodel in mind? What is going on? We just had a client that we think is going to buy a motor home to travel around. And so they're really excited about that. Number 2, look at your, if you have a retirement plan that has a lump sum option, you'll have a decision to make there. What is the discount rate? What are the dates that you would need to make a decision by? A lot of people will time their retirement, and there's typically a delay when market interest rates start higher, and market interest rates do look like they're heading a little bit higher. The 10-year bond this morning is up to about 1.1, a little bit over 1.1%. It reached the low of about 0.36 back in the March time period. Whether you're over 59.5 or under 59.5 factors into your planning. How do you get income? Will there be a severance involved? When do you take it? How do you get your money out of your IRA if you're under 59.5 without taking a 10% penalty? So we're creating a retirement income strategy, perhaps taking some money out of retirement plans, perhaps taking some money out of after-tax assets, perhaps accessing some restricted stock or some payout on some company benefits. As I said, we're monitoring the retirement plan discount rate. We're monitoring, working with your CPA on ordinary income versus capital gains tax rates. As Matt mentioned earlier, subject to change this year, new administration, and talk about some of the things that happen. That's probably the most often asked question we get. Are rates going to go up this year? With weakness in the economy, some of the if you will, folks that have a finger on the pulse say that they do not expect the new income tax and capital gains tax rates until 2022, but who knows? And number 7, we think a qualified and a fiduciary-centric advisor can add value. Perhaps not in your situation, but we certainly think, given the complexity and given the importance of the evaluation and the critical decisions, that this should be part of everyone's at least consult with regards to that. So from a standpoint, Income needs in retirement. We talk about the hidden tax of inflation. Inflation, a 3% inflation will double your cost of living in 24 years. A 4% inflation will double your cost of living in 18 years. So we're interested in planning with real terms. In other words, inflation adjusting what you're spending to make sure that we're not just taking out, an example, $5,000 a month and thinking that's not going to need to go higher because things are costing more. Income needs during retirement. My joke is the bank of mom and dad is always open. So depending on the situation with your children, it can be where you have unintended or unanticipated expenses with regards to perhaps health or needs for your children/grandchildren. Many of our clients are having a grand time having grandchildren and wish to make contributions to the 529 plans. So again, planning for income needs during retirement. We talked about travel, not as much of that going on. What are your ongoing fixed and also variable expenses? And then you may be making gifts to the family. Rule of thumb, and it's worked really well over time period. Take 70 to 80% of what you're spending prior to retirement, and that is a good starting point for that. But again, subject to specifics with regards to peculiarities of your individual lifestyle.
And by the way, chat box open. Any questions along the way? We're watching this, and we'll try to answer your questions in real time when we see them pop up. But there was a white paper written by Trinity University recently. Is 3% the new 4%? And here we're looking at a study dating from 1926, actually through the 90s. And what we see here is that a 4% withdrawal worked in most markets. The 4% rule, which most everyone is familiar with, that study was done there during the 70s, 80s, and 90s. What's the difference between those 3 decades and now? Interest rates are a whole lot lower than they were then. So one could make a fairly compelling argument that 3% is the new 4%, just based off the fact that interest rates are a lot lower than they were when this study was done. What the Federal Reserve has ultimately done, right or wrong, is they have forced retirees into risk assets, i.e. stocks. And so that's where this family index number really comes to help our clients. Our goal for our clients is we want to take the least amount of risk possible to get you from here to there. And there is going to be into your mid-90s and still have money left over if that is your goal. And so with that being said, it was, back in the 80s, 90s, it was a lot easier to get a 4 or 5% rate of return, or income that is, with 20 to 25% stock allocation. Having just a quarter in stocks now, you'd be much more hard pressed to average a 4 or 5% rate of return, just given the fact that bond yields are so low. So something to consider. The age at which you retire obviously plays a part into that as well.
So you have a decision of a retirement plan. Do you take it as a monthly annuity, or do you take that as a lump sum? If you take it as a monthly annuity, which monthly annuity do you want? A 50%, 100% joint survivor, period certain? So there are some decisions to make there. We've listed here the pros and cons of the pension plan, income for life, limited flexibility versus the lump sum. People many times like to have their money in their hand to give them more financial flexibility, can provide inflation protection, which is a big thing if you think that interest rates and inflation are going to move higher over time. On the con side, if you're not judicious with your spending, and you're being a good steward of what you have, you can spend more than you want. So you have an investment process. Are you interested in potential inheritance for your heirs? What is your break even when comparing the lump sum and the company monthly pension? Where do interest rates go from here? Again, this discussion that we have with folks, and again, where that wealth coach can come in handy with regards to some of the decisions that need to be made. Early retirement, pre-59 and a half. There are ways to access one-time, if you're less than 59 and a half, what we call 72T, or equal distributions over greater of 5 years until you reach 59 and a half. Net unrealized appreciation, selling some stock at average cost basis, one-time distribution, using a line of credit, maybe working a little bit, and or support your lifestyle via some after-tax assets. So again, this is all part of the planning. Each person, each family is unique, and this is all part of what we call our Live Well plan.
One other thing that we do recommend at least considering, if you do have some capital gains in an after-tax account, here are the current tax brackets as far as what capital gains tax rates are lined up next to their taxable income. Obviously, you see them down here in kind of the pinkish red. There is a 0% capital gains bracket. So this is once again subject to change with the new Biden administration, something they have talked about updating for some of the higher income earners. We would expect to see some type of change. Don't think these lower brackets probably will come to be changed that much. Obviously, you'd want to consult with your CPA on something like this, but there are some neat planning opportunities waiting until retirement and possibly taking capital gains and paying a lower gain than you would when you're currently working. Talked a little bit about income in retirement. Here's a chart dating back to the early 1940s through the end of 2018. It's a few years old, but the dated material, it doesn't change much year over year. I guess you'd call that a yellow, kind of that mustard yellow color would be the dividend contribution to the total return. And look at this, over a 90-year period, dividends have equated for over 40% of the total return of the stock market. And so to say dividends don't matter is an understatement, to say the least. We think dividend stocks are a whole lot like a Christmas tree farm. We like to plant these Christmas trees a few years before retirement. Our portfolio of dividend growth stocks, we're looking for companies that have a propensity to increase their income year over year. What does that mean to you? That means a rising income stream in retirement, which we think is paramount given the low interest rate state of the world. And so we're looking for companies, we'll jokingly say, that abide by the GGG rule. If they go out of business, you better have a gun, a garden, and some gold, because nothing else at that point probably is going to matter. But dividends really do matter, we think, before retirement, but also even more so in retirement.
So we got the question, how safe are bonds? Great slide here, and we really don't have time to give it full discussion, but there have been periods of time where, if you will, bonds 1920 to 1940 have done very well on a real rate of return after inflation. And then you see the middle period, long period of time where bonds did not do well because interest rates were rising. And then you saw a third period where interest bonds, treasury notes, treasury bonds did very well because of declining interest rates. Obviously, there's three snapshots. The snapshot that's most important would be what's ahead of you, and that is where an investment process comes in very handy. Let's talk about investing without a process. A little bit of a busy slide, but a good slide. The dark green line shows the stock market, whether it's going up or going down. And you see there the first circle shows people putting a lot of money. Those are equity money that's going into mutual funds, people buying stocks when things are going well. And then you see down in 2008 on the right-hand side, the circle where people are selling stocks when they are low. And obviously that's the flip opposite of what we want to do. We want to buy low and sell high. So emotion, with an investing process, you keep emotion out of it. But without a process, without someone to help, it's very difficult not to get caught up in the moment. Why do you need an investment process? As we said, many investors will make poor financial decisions when they're stressed. There's medical science to back that up on what the logic part of your brain actually doesn't do as good a job. We think discipline, income generations, and income generation are great core principles. Here at the Price Group, they are the core principles. We want to protect your assets and make sure you have the level of income that you need to meet your objectives with, as Matt talked about, that minimum risk.
So let's talk just briefly about planning after retirement, what that does look like. This is a big part of our Live Well plan that we're happy to put together for you on a complimentary basis. But you say, well, I'm going to just own all stocks, and if they go up, great. If they go down, I have an appetite for that. It doesn't bother me. Well, that might be right, but if you're taking money out of the portfolio, you need a much higher return on the backside of a market correction to get back to break even. So let's just take a look here. Let's say portfolio is down 20%. You're taking out 4% withdrawal rate. When you include inflation, you need almost 36% just to get back to break even. And so, like we've mentioned now a couple of times, retirement is not about outperforming some arbitrary index. Retirement has to be more of an income game. Retirement has to be a way to protect your portfolio in a falling market. Our Live Well plan is a big aspect of that, but having a conservative investment process, we think is now, with markets at all-time high, more important than ever to consider. So looking here, go ahead, Randy.
Few planning ideas for consideration. Your IRA, you can do qualified charitable distributions, gift appreciated stock, Roth conversions we talked about, a lot of things. And again, each of these topics could be a separate discussion. So big picture summary is a lot of considerations, a lot of things to look at, a lot of decisions to make, and complexity of retirement we think is really is large, and so therefore we recommend that folks look before they leap, which is obviously the title of our podcast this morning. So
what we would say is if you're interested, we'd be happy to create a complimentary Live Well plan. It's a look to, like Randy said earlier, comfort, confidence, and clarity are the 3 C's we're looking for when doing this type of exercise. We would show you what an investment portfolio would look like. We're very transparent with our cost structure, laying that out on there. But our promise is this: you'll leave a little more educated than you did prior to doing the plan. And if it works out, great. If not, we shake hands, part as friends, and hopefully it's a valuable exercise to you. If it's us, if it's someone else, here would be what I would want to tell my wife if she was out shopping, kicking the tires, looking for an advisor. We would say being a fiduciary is the #1 thing to consider. If the advisor is not a fiduciary, that should be a deal breaker in our perspective. People who are representing an institution, a bank, a brokerage firm, and are not serving as a fiduciary, there is a conflict of interest there, whether they realize it or not. We think experience matters. Randy and I both are certified financial planners. We both attended the Wharton School of Business to obtain our Certified Investment Management Analyst, our CIMA designation. we would say 20 plus years of experience is what you should be looking for. And then someone does have a bunch of gray hair, you want to make sure they have a succession plan in place for when they do retire. You know, Randy is, we didn't mention he's my father. He tries to say he's my older brother, but I've inherited some of his bad genes from some of his corny dad jokes. And one of his favorite jokes is this: you know, if you have a heart issue and you're looking for someone to perform heart surgery, do you want a doctor that does hearts on Mondays, big toes on Tuesdays, and gallbladders on Wednesdays? No, of course not. You want someone that solely focuses on hearts. And we think the same is true for retirement planning. About 90% of our clients are retired. The other 10% are within a couple of years of retirement. The Price Group manages almost $600 million of assets, and we have a select number of families that we do serve. So last two pieces would be a personal plan. We see a lot of people get pushed into these cookie cutter type portfolios. We have 15 different investment strategies that we run for clients, and it's a personalized touch that we create this investment portfolio based on your personalized live well plan. So nothing we do is cookie cutter, and I'd argue the second most important piece would be communicating well. That would be that the advisor you would look to hire can communicate well, but also that you can communicate well with the advisor. They speak in terms that are easy to understand, and you have a good working relationship with them. So this is a little bit of a snip. We do have a guide, 10 questions you should ask every financial advisor. If you'd like a copy of that, shoot me an email. Happy to email it to you. You can also download it off of our website. But that would be just our 2 cents when kicking the tires, trying to hire someone that does what we do.
Okay, the trains are running on time. We very much appreciate your time on this crisp, sunny Tuesday morning. Please reach out to us with any questions or comments. Randy.Price, Matt.Price, our firm, again, employee-owned firm, stewardpartners.com. Telephone number there, picture of Tiffany, Melissa, and Maddie also. So the 5 of us make up the Price Group, and hope to talk to you, hope to hear from you. Matt, do we have any questions from the live chat box? If not,
no questions, but as we end here, certainly appreciate everyone attending. There's going to be a 2-question survey to fill out, and we would appreciate just 1-2 minutes of your time with that for our compliance records for your attendance. And if we could be any service, certainly let us know, and we'll hopefully look forward to catching up soon.
Take care. Thanks again.